Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, we were returning to the top 5 in the S&P 500 and this time it's Amazon. Turns out it's actually been a long time since I looked at Amazon. I've obviously been avoiding it while I've done Google and Microsoft and Apple and Tesla, and I've been revisiting them semi-regularly, and I'm comfortable with the situation with the Elliott wave counts in all of them. I am not comfortable with the Elliott wave count here in Amazon. Now the long term's not a problem. There's a lot of geometry and classical analysis which supports my long-term interpretation. The short term, going into the highs of 2021, and you might say that's not short term. It is for me. I've been holding Amazon stock for frickin' ever. So going into the 21 high and coming out of the 21 high is short term, and that short term count looks absolutely diabolically horrible in terms of trying to make it work, trying to make it follow rules, trying to make it make sense. So I'm not promising you some kind of Elliott wave piece of magic which is going to explain exactly how we bottomed and now we're going higher, or exactly how we're halfway down and we're going lower, because it is not clear. Right, so if you were hoping for just the clearest Elliott wave count and you're going to be disappointed by not having it, you might as well stop watching the video now. Right, but I wanted to come in and cover the Elliott wave count later. I wanted to start with the classical analysis first. Now, I mentioned in last week's video on Apple how you don't turn your nose up at the opportunity to buy Apple after a 30% sell-off. Alright, and you don't turn your nose up, in my opinion, or look a gift horse in the mouth, as they say, when Amazon sells off almost 60%, right, or 57% in this case. You just buy the damn thing. Alright, now this is a long-term investor talking rather than the short-term Elliott wave trader I can choose to be when I want to be. Alright, this is just someone who's saying you're not talking about some shit coin in the crypto sphere. Alright, you're not talking about some bullshit company with no earnings, right, and no income. You're talking about Amazon. And if you go and look at this company's finances on your own, you can go and value it yourself in the space of 5 minutes and use any metric you want. Now, if you're expecting a 90% sell-off, perhaps you're being a bit greedy. If you weren't satisfied with 60, perhaps you're being a bit greedy. And are you truly valuing this company correctly? Yeah, so on that basis, I would argue, same as I did with Apple, which is we're talking about proven track records, proven trends, proven companies with mega cap stocks, right, is what we're talking about. So let's look at it from that viewpoint first and then come in and worry about the Elliott wave count. So let's just turn off the Elliott wave count for a moment and just look at some long-term geometry we've got here. Now, if you've ever looked at or read Elliott wave theory yourself and you're familiar with wave structure, and we just take on a logarithmic chart, we move into the tech bubble, the 90% pullback when Amazon was not a mega cap stock, when it was selling books online. That's how it all began, right? And then we look at another pivot here, and then another pivot here, and then we get this. All of this is smaller, shorter, shallower pullbacks, and now we get this. Not so much. Now, anyone who knows what this looks like knows that this looks like a wave 3 extension. Okay, where we have a larger degree pivot, a lesser degree pivot, another lesser degree pivot, and then a long wave 3 with what's the word? Exaggerated subdivision within it. Exaggerated subdivision. I love that phrase, but that's exactly what we're talking about here. Exaggerated subdivision, right? All the wiggly jiggly biggly bits going in the middle, and that's a wave 3 extension. That's about as typical as one can look. Right. So going on that premise, we built our geometry around that major pivot and some channels around the subsequent pivots to express how the long-term logarithmic trend is still very much intact. Very, very much intact. So let's just do that. So we've got, this is that's a smaller time frame one, but it's absolutely relevant, as we can see. I'm just looking for the longer term stuff. Okay, so super cycle pitchfork. Right. From this dominant swing here, we can see how throughout the years since the turn of the millennium, we've come up to the median line, back tested it here. We've hung around the 38.2 before, we've hit this several times, 61.8 here as well. Channeled between the median line with these highs and the 23.6 here. Moved above the median line, back tested it, moved up to this 38.2, 23.6, 38.2, 23.6, above the 38.2, blah blah blah. And then we've had a big correction down to the median line, back up, and then a big correction down to the 23.6. So we're still well within all of this long-term geometry. If we move it down a degree to cycle wave degree, we can see how we're still some way off the bottom of the pitchfork here. Now, we could be on a journey down to there. That's a possibility. 60 odd bucks. Right. Now, would you be a buyer here? You've got to ask yourself. Now, it's easy to say, yeah, I would be, Tom. You know, I'd be a buyer here because we would have sold off, you know, what are we talking? We would have sold off 66%. Well, we sold off 57%, and there are people out there who didn't want to buy it. So, take my point. It's like nobody would have known or have expected that that's how deep down we would have come when we were back at the all-time highs, would they? But they would have all swore to you that if it had sold off 30%, 40%, 50%, they would have bought it. So there's always going to be those people who won't buy it no matter what. It's just, I don't know why, it's just who they are. Now, if we move on and have a look at our... here it is, the primary trend, right? So this is... let's bring up a simple... let's bring up a count, as we can basically see here. So, we've looked at the geometry around this major pivot, the geometry around this major pivot, and we can see now that we've gone 1 2 1 2 1 2. All I've done here is used Elliott's first method, excuse me, for the placement of an Elliott wave channel. Now, there's two ways of looking at how we get through the high here. The channel is based with this being a 3 and a 3, and then another complex correction down here. I can move the channel down to this high here, which would give us a slightly deeper low expected for the 4, or I could even use the second method of assuming the 4's in, take the 2 from the 4, project from the 3 to find the 5. Either way, it channels nicely is my point, right? And it basically swings high, swing low, through the median line, bounce off a 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 median line, break it, work our way back through it, bounce off a median line, head for the top, bounce off a median line, bounce off a median line, head to the top, hit the median line, bounce, down through the median line, back check it, back test it, fall to the bottom. Right. So we've been interacting the whole time. If we put a fib channel around this and saw various levels, you'd just be seeing the same thing moving between the 61.8, the 50, 38.2 and so on and so forth, right, as we sometimes do. So point being, it's still channeling. Okay? Still within long-term geometry, still channeling. So now let's have a look at, on the monthly time frame, let's bring up our momentum indicators here. Now, we haven't seen oversold conditions, the likes of this, since the tech bubble back in 2000. On the monthly time frame. Rare to reach oversold conditions on the monthly time frame. Okay? We can literally see that's self-evident in this case. Right? We're back at neutral on the monthly. And we can see how if we bring up our MACD for a moment, we can see how, let's just try and find the last, so here's that big bear market back in 2000. Okay, here's the subsequent cross of the signal through the average and then move into a bullish phase, bearish phase, bullish phase, bearish phase, bullish, so on and so forth, with this bearish swings between bearish and bullish momentum. Here's the sell-off into the bearish momentum that built up through the what was this, 2018? So this was December 2018. Oh yeah, the taper tantrum into the power pivot at the bottom of 2018. I forgot for a moment. you know, we've been raising rates through here, and then we were like, oh my god, it's hurting things, let's cut everything and go back to zero. Yeah, and then we had bearish phase here, then a big swing up. That was out of the back of COVID, you know, unlimited free money for everyone and their mates. Off we went to new highs. And then we had a huge build up of bearish momentum. Big build up of bearish momentum. And now that has, for the first month, produced its first teeny tiny little green bar on the histogram. Bearish momentum has subsided and we're about to cross the average through the signal. Now, through all the prior endings of these major corrections, right, when we get this MACD cross and the burst of bullish momentum, whether it's the one we're seeing now, this one back here, this one, and all the way back to that big one in 2000, right, or 2001. Once that bearish phase is over, we move into a new bullish phase and price moves to new highs. So if we were to break the trend of that happening, we could go lower, right, and not move to new highs over the next couple of years. We could even correct lower to a double bottom while the price is, momentum is still bullish, if you take my meaning. Like, we can go sideways like we did here and have bearish behavior. We can also go into corrections like we did here and here and here and still have a bullish phase, right? But it's highly likely, I feel, that if we do cross over on the monthly time frame and we have reached oversold conditions on the monthly time frame, right, then it's highly likely that was the low. That's a sustainable low. Right, so now let's come into the daily time frame and bring up our primary channel for a moment. Sorry, our daily time frame. And let's bring up our exponential moving averages for a moment. So, throughout the history of the bullish and bearish phases of this asset, as we see with the crossover for 60 through the 250 here, we were already rallying into a new bull market by the time the 60 crossed through the 250 to the upside. We had the same here where we crossed down through the 260, 250 stayed below it, and once the 60 crossed through the 250 and back tested it, we were already into a new bullish phase. By the time the 60 crossed back above the 250 here, we were already into a new bullish phase. We'd been moving off of the lows, and then we stayed above it. This is how I get the feeling, like when I look at the length in the size of the price corrections, 95%, 57%, 65%, and the length of time that they took, right, combined with the moving averages, we get these major bearish phases. Now when we get into this section, all of this, we don't get anything of the like until we come to present day, right? That's 60 trends above the 250 and we get lots of small corrections. So it stands to reason that the first bigger correction is related to the last bigger correction that we saw down here. So if we've gone 1, 2, 1, 2, 1, 2, all of this is 3, 4, 3, 4, 3, 4, and that's what my long-term count suggests. And if we look at the geometry and the price behavior, that makes sense. That seems to make perfect sense. So we may well have bottomed in a 4 here. We're going to come back up in a fifth of a 3 to get a 4, come back up in a fifth of a 3 to get a 4, come back in a fifth, and so on and so forth. And that's how Amazon's going to march higher as it completes those larger wave degrees over the next couple of decades or longer. Alright, because we've got a lot of sideways shit to come if we're going into these larger wave degrees. We've got a bit of a trader's paradise of just big pivots coming. Alright, so there you go. We've spoken about how the behavior of these moving averages. We haven't crossed back over yet. We are trading above the 250 exponential moving average for the first time in any significant manner since crossing below it in price, but we haven't brought the 60 back through the 250 yet. So we haven't quite got that bullish signal. Alright then. Alright, so now let's apply some classical analysis also to this correction that we've been in, this 57% drawdown that we've had, and see what we can see. So first thing you have to point out, and you have to admit, bullish or bearish, is we're still in a downward trend. We're still in a sequence of lower lows and lower highs, and we haven't broken that. Right, our major pivot to break that here is at 146.57. Until we get back above that level, excuse me, we are still technically in a downward trend. Right. So, a lot to prove yet. If we take some of our corrective geometry here to explain all of this, got a bunch of stuff here. So first and simplest is just a resistance line, right? From this high and this high, being as generous to the bears as possible in terms of finding the greatest range for the downward trend line to be before it's broken. You could draw it steeper, but then I think you're favouring a bullish interpretation. And even if you are bullish long term, which I am from this low, you still have to give the bears as much credit as possible, because you increase your odds of being right if you break all of that bearish structure. Best fit channel is the best I can do from the high, as I can't get a corrective channel to fit it, because we come off of this swing low here or this swing low, and we cut out a lot of the price action. So I'm happy with that as a best fit channel. It's the same two highs, it's basically the same trend line, right? And then we've got a pitchfork based off from the intraday high to what I've considered to be the first major swing high, swing low, swing high, the first major pivot here. And we can see how we've come right to the extreme of the pitchfork, 200, right to the extreme again. We've spent time around the inner bound, the 100, and then we've come into the median line on multiple occasions, and now we've broken the 100 to this side. So if we were to repeat the same kind of extreme price action, you could come up to the 200, stay below that major pivot, and still roll over. It is very difficult at the moment to say with any certainty whether this represents a bottom. Like I said, there's a lot of evidence which we've gone through for the classical analysis earlier in the video which suggests that it is a bottom, but from an anyway point of view, as we're about to discover, is not so clear. So the last thing I want to touch on is some just basic support and resistance, and the demand zones that we've come into right here, and then we've bounced, and this was a significant Fibonacci retracement as well. On that same note, we're coming into a significant Fibonacci retracement from the most recent swing high, swing low here, heading into the golden zone. We tagged the 50 exactly, pulled back. I think it was the 78.6. I'm not 100% sure. Bear with me. Just about shy of the 78.6. That's in log. Let's come off of log. Yeah, if we come off of log, we can see that it's exactly the 78.6 that we tag. So we go to the 50. We often visit the 50 as the first place we'll pivot. Then we come to the 78.6, fail to make a new low, don't make a lower low, and now swing to make a new higher high. So we've now got high, low, higher high. We now need a higher low and another higher high, and we've got a trend at that point. But we're not there yet. We could just have a corrective three-way swing, couldn't we? Okay, so we're coming into that 61.8 off of this pivot. Now if we look at the higher pivot up here, which is from the intraday high, and come down, we can see that we've got some serious resistance, which we've seen with our support and resistance here. Right, here's the 50. The 50 is these lows, right? And we've got resistance above and below it as well. We might as well pop another line here and say, well, this is going to be resistance as well. We can see the interaction with these prior lows, prior support becoming resistance. Okay, so we've got that to come into as well. So and that's still prior to that major pivot, which we discussed here. So we've still got a lot of work to do before we undo the big damage which was caused by this almost 60% drawdown. Right. And the last thing I want to do is just use a regression channel from high to low. Now we can see with our regression channel here, which is the blue lines represent 2 standard deviations from the mean of all the data within the channel. 2 standard deviations accounts for roughly 98% of all results within a what do you call a selection of results? There's a technical term for it. Within a field, I think it's field. Of 2 standard deviations of all the results within a field, and we've broken that trend here as well. So that could be seen as positive. We'll pop that in the corrective geometry folder here. Okay, so let's cut the crap and get onto the actual Elliott wave itself. So it's just a mess. We're just going to deal with it as best as we can. I'll show you what we've got. So getting into the high. The issue is this is a high and this is a high and this is basically a double top. Right? It's a slightly lower high. So depending on where we want the count to finish, we want to finish on the dominant high, which makes the most sense. We do appear to have an impulse into this little move here. We also could have a zigzag into this high, and it could be part of a larger corrective structure. What we're left with is trying to make sense of this. And we want it to finish motively. So good luck with that. And if we want to suggest that the whole thing is a sideways correction, right, which would be believable if it carried on doing this, we would then have to somehow include this. Right. So there's problems. We could look at it like this then and say, well, alright, we'll take a natural finish of 1, 2, 3, 4, 5, and we'll go 3-way swing into W, 3-way swing into X, and then for some reason this then happens as the Y. Right, fine, whatever. Okay. Bottoms here then, or should we just put in another X wave and then another Z? Yeah, fuck off, whatever. It doesn't matter at that point, does it? It's just absolute mess. So, fine. We could look at it like that, but I've decided to look at it slightly differently. I've decided to get the high at the dominant high. Here. This is where we top. Dominant high, it just makes life a lot simpler for everything that follows. Okay? Because I can keep the whole count cleaner at that point. Now this is a mess. We get a W zigzag, we get an X wave, and then we get a very convoluted running flat pattern. A, B, C, with an internal B wave flat with a perfect 5-wave structure in the C adjoining at minuet B. So WX, big flat for the Y. Best I can do it. It's ugly as hell, but that gives us our minor wave 4, and then 1, 2, 3, 4, 5 into the high to finish the top. That's the way I've gone about it. Now, if you want to say it's W, X, Y, that's fine. Honestly, I don't think there's anything to pick between them, and arguing over such things when we're left with this massive topping structure of back and forth, sideways, overlapping price action, arguing over that will be a waste of time, because it could be either of them. Right, I've gone with this because it gives me a dominant high to work from, which allows all of my geometry that I want to include in this downward move to make a lot more sense than trying to take it from this swing back here where it won't fit anything. It won't fit a channel, won't fit a pitchfork, won't fit a regression channel. It's all completely useless. If I can take it from a dominant high, all of a sudden this looks like it makes a lot more sense. So that's how I've done it. Now from the high, we come down in this corrective structure. 5 into A, ABC minute degree minor B, 5 into C, intermediate W, ABC minor into intermediate X, ABC minor into intermediate Y, into primary 4. Double zigzag. Super simple. Here's the first zigzag, and here's the second zigzag, with the adjoining X wave in between, which is a flat. Right. Looks similar to what we've seen in the S&P and the Nasdaq. Makes sense, therefore much happier to take it from this high than back here. So ABCW, ABCX, ABCY. Now from here we've got to get off of the low, and it's tricky. Tricky. Alright, so how about we start with a cheat first, something that you're not allowed to do, which is illegal. So an illegal count, Tom, that you shouldn't even be considering. Right, but there are people out there who will consider it, and I'm not having a go saying that you shouldn't. You've got a valid argument if you work off of this basis. So, if we just put the chart into daytime frame for a moment, and we put the chart into line, then we get a very bullish count. Come down to the 4 hour. We get 1, 2, 3, 4, 5 into 1, sharp into 2 to the 78.6%. Which we've seen, and then 1, 2, 1, 2, 1, 2, now accelerating in a 3. It's an extension. and it's going to wave 3 extension, it's going to balloon, it's going to go mental, it's just going to go flying up. Problem is, on the candlestick chart, this was a lower low, so we went lower. Price made a new low. It went there, it traded there, it happened. Right, so for me, I can't allow this. Right, 1, 2, 3, 4, 5. So that limits our options at that point. So we get rid of a cheat extension. Now if you're just using the line chart, and some people do because they say, well, Elliott never had candlestick charts, so you only use the line chart, and that's a higher low on the line chart, so that's what I'm going to do. Fine, that's legit. I'm not going to argue with you if that's what you want to do. I've seen far too often, well, not too often, but often enough to make me doubt that validity. If a count isn't legal on the candlestick chart because price broke it by trading where it shouldn't, it often doesn't play out as it should. Now, I've got very skating on thin ice by saying that, because it's a subjective art form, and what one person sees as illegal and one person sees as legal, and one person sees as, well, that did invalidate, that didn't invalidate, this is a sideways structure, so it wasn't into the price territory, shouldn't have been, this did not transgress into wave 1, this did transgress into wave 1, and yada yada yada. We could go back forever, so I'm just not going to tell you that there's a right way or a wrong way. I'm just going to tell you that for me, if wave 2 trades below where wave 1 began, I'm not considering it. It's just the rules I follow, okay? So that takes that idea away. So what we're left with is a diagonal, okay, where we have 3 waves into a 1 because we're using a diagonal. It could be a leading diagonal, it is a leading diagonal, but it doesn't have to be 5 waves, it could be 3 waves. I don't know why some people just seem to always insist that a leading diagonal has to be 5, it does not. Within each subwave, 1, 2, 3, 4, 5. Now this subdivides as a diagonal in the A, B, and now an impulse in the C. If we go beyond 121.01, then it can't be a contracting diagonal, because the 3 would have to be shorter than the 1. So that leaves an expanding diagonal open. Okay, or it's something else. Or it's something else. Now, the only other thing I've got, and that could be anything really within an expanding diagonal, to go higher and higher and higher. Or if you're taking the count off of the lowest 5, you don't have that problem, it just continues to extend. Alternatively, it's corrective. And the only way I could make this go lower is to just rather lazily put in another zigzag. Like so. So we've gone W, X, Y, but the Y wasn't here. There's another swing inside. So it's W, X, Y, X, and now this is A, B, C with a W, X, Y correction within it. Now, I can't use a flat, even though we've led with 3, because we don't come back to 89% of the move up for the A, in which we have to do that in a B. And this would still subdivide as an extension for a C. That would be fine because it could subdivide as 5, A, B, C. But I can't use it as a flat because it doesn't follow the rules for 1. And we lead with 3. So if we lead with 3, this is a zigzag, and therefore this is a zigzag. Okay? And at that point, once this finishes, now the reason I've got these extensions here is that's the extension for the W, for the Y from the W, and that's the extension for the C from the A. From the A, here, B, C. One to one. And the channel you're seeing is just a corrective channel, what we call a base channel, because if we take out these levels and then we come through the base channel, backtest it and move higher, this is impulsive all along and this is motive, and you're going to have to explain it to yourself because if it's not a diagonal, it's an impulse. So bar a truncated low being here, that's the only solution I could find. Alternatively, and it's so far off the other low, it just doesn't seem right. So it's tricky, like I said, and it is what it is. We got some volume coming in here on this move. Okay, we've got some pretty strong momentum coming in. We know that we've seen that shift in the MACD on the monthly time frame. There's every reason to think this is the low, but we haven't got many ways of explaining it. So what are we looking for? Well, that major pivot's a long way away. Right. So if it's the diagonal, we want to see price roll over before 121.01, and if we're lucky, we'll get 1, 2, 3, 4, 5 in a rising wedge. There's our diag. Back in 2, off in 3. If we break that level, we have to delete the idea of it being a contracting diagonal and open up the idea that it's an expanding diagonal. So we led with 3, we got 2, and then this will be a larger A, B, C, up to here, and then a larger 4, and then a larger 5. We'll get an expanding structure out of here. Alternatively, it's somehow an extension, and there is 5 waves in here somehow, but we can't have it from this earlier load because it's illegal. So I can't see how. I really can't. This is behaving like it should be right, but this is not. So I just can't do anything with that. Finally, bearish should stay within a corrective channel. We know we're coming back to the golden zone. Here's the 61.8, 65. We know we've got serious resistance, support resistance right around this level. If we respect that resistance, respect that golden zone, respect these one-to-one relationships which are sandwiched around it perfectly, and respect this corrective channel, there's every chance that it's just a three-wave correction, and then we're going to seek out new lows. If all of these corrective structures break down and move higher, then it's highly unlikely to be corrective. It was more likely a bullish low. So we're going to have to leave it for a while and come back to this once it explains itself, and hopefully we'll be a bit wiser. But at the moment, I feel like this is the best I can do, and the reason I've covered Amazon is it's taken me a long time to get round to it, so I felt I just had to do it. But either way, I hope it's been of some use to you, given a few things to look at. And that's it, guys. Like I said, very busy at the moment. Mrs. has gone back to work, and I'm now full-time parenting again, so I'm getting roughly a video out a week on YouTube and spending the rest of my time trying to keep the patrons updated. So and that's proving to be a bit of a struggle. But if you are interested in joining the Patreon, the link in the description box below, you can head over there, and there's a 16-episode series on Elliott Wave Theory if you want to take the time to learn it for yourself, plus a whole bunch of other trading videos as well and educational content which isn't available here on YouTube. Feel free to sign up. And yeah, thanks for watching, guys. Take care of yourselves, and I'll be back with you as soon as possible. All the best. Bye bye.